Wedell here. I'm the Chief Investment Officer at RFG Advisory, obviously filming on location today. We thought we would bring you a quick market update to let you know what's going on out there. S&P 500 right at about 75.16. That is up about 9.6% year to date. Little bit off the highs, about 7,600 is the high, but certainly recovered quite a bit versus where we were a couple of months ago. As I think about the news that's out there, we sort of have both Iran and what is going on with the potential resolution to that conflict, as well as news around the Fed. And on the former, I will just say that I don't think that we have necessarily seen the last of some what I'll call turbulence as it relates to what's going on with the Strait of Hormuz. Over the weekend, we saw briefly that the strait was closed again and then it was reopened. Obviously, there are ongoing talks between both sides in terms of what the future of that deal will look like. You had some rhetoric over the weekend that suggested that shooting might start again. And I would just note that I think that these two sides have a very uneasy truce between the two. Iran is obviously going to look to extract as much value as it possibly can from its current strategic situation, including, levying fees on tankers coming out of the Gulf and, the 300 billion and what exactly is it going to do with its nuclear program, et cetera. And so in that situation, I think that both sides are going to spend a lot of time going back and forth, and we may see rhetoric, which may move oil prices or may move the market one direction or another, depending on how serious it gets. And once again, for rhetoric to be effective, it kind of has to be serious. So we'll see, but I don't think that the turbulence that we've seen out of that particular situation is all finished. Secondly, we have the Fed. And the Fed's meeting last week was decidedly more hawkish, significantly more concerned about the inflation outlook for the country. You essentially have forward interest rate markets now with almost 100% probability of a rate hike by September. And I just think the inflation picture itself has gotten worse during the first 6 months of this year. We will get a better read on that later this week on Wednesday when we get the PCE, personal consumption expenditure, inflation data, which I would note is the Fed's preferred measure of inflation data. The second thing that we have going on with the Fed that's a little bit more subtle is that the incoming Fed chair is less enthusiastic about the Fed being, very, very open door about what it's thinking with respect to future rate changes. So this is a Fed chair who believes that playing the cards close to the vest actually gives the Fed more flexibility to be able to pivot and change on a dime if they need to move from hawkish to dovish and whatnot. This was more like the way the Fed was in the Greenspan era, where people are like, oh my God, he blinked when he said this during the press conference, and that must mean this. The outgoing Fed chair was a bigger fan of clarity and a bigger fan of, I'll say, over communicating, because he felt that would reduce some volatility in the marketplace. We will see how that plays out, but I would expect a little bit more volatility around Fed rate decisions going forward. And obviously, we'll get an important data point on Wednesday, and we will keep track of all of that for you. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a fantastic day, and I look forward to talking to you again soon.